everyone, this is Fahad Ali again with video, and this time the video is all about the introduction of the debit and credit. Okay, we have learned that concept of T accounts. We have learned the concepts of assets, liabilities, capital, and expenses and revenue. So we'll just move on to the T accounts introduction. But before we proceed with that, we have to just go for the debit and credit. So what is the debit and credit? When we are learning the debit and credit thing for the very first time, the very concept which is given to the student is that anything which comes in the business, anything which goes out of the business is credit. Okay, anything which goes out of the business is credit, and anything which comes in the business is termed as debit. So you just need to make your basics clear that comes in the business. Okay, so let me write some transactions over here. The first transaction which I'll be writing it over here is this: started business with $5,000 in cash. Okay, so there are something which is coming in the business, which is that this 5,000 which is coming in the business. But majority of times students make one mistake. What is that? Students say that the business and the owner both are same, but this is not true in accounting world. They both are different people, they both are different things. So we need to remember this thing. You have to think from the perspective of the business, you don't have to think from the perspective of the owner. Because when we are doing these type of transactions, the students say, sir, the owner is losing the money because he is investing in the business, so the owner should be credited. No, we need to see that whether the business is getting something or not. So we need to see this thing. So this is a capital. When you are investing something and the owner is investing, it is termed as capital. So what will be the debit and credit in the transaction? You can see this. It will be capital credit by how much amount? $5,000. So what is coming in the business? The business is receiving some cash. So cash will be debit by 5,000. Let me write another transaction over here for you. Bought goods by credit from Amir $3,000. Okay. So if I'm saying bought goods on credit, it means that I have bought something on credit. So this means that nothing is going out of the business, but something is coming in the business. What is that? Goods. Goods don't have any T account. When the goods are bought, it is termed as purchases. When the goods are sold, it is termed as sales. So we need to either choose between these. So we have bought goods, so it is a purchases thing. So sir, purchases means goods are coming in the business, so it should be debited. Okay, correct. So what about the credit thing? We have bought some goods on credit from whom? From Amir. So Amir should be credited in that case with $3,000. Next transaction which is there in the question. Bought equipment. Bought equipment paying by check. $3,000. Okay. So when we have bought an equipment, sir, we have got an equipment, so we should be writing purchases. No, purchases and sales word is only for the goods. When you are either selling goods or buying goods, you use the word purchases or sales. Otherwise, you will use the word itself. Equipment is a non-current asset, so equipment should be written down. It is coming in the business, so it should be debited. But how you are paying? You are paying by check. So check means bank. So bank would be credited. Whenever the word check comes, you should be writing bank on this. Sorry, 3,000 or 4,000. And I have already invented one of the formulas. The Newton's third law of motion says every action has an equal and opposite reaction. But this time I'm saying every debit has an equal and opposite credit. How? You can see that cash has been debited 5,000. So it has an equal and opposite credit, which is capital. How do I say equal? It means the amount is same. How do I say opposite? Because cash is debited, capital is credited for that. So these type of transactions are there in the questions. You need to solve those. You will get a clear idea about these things. Okay. And things which will be moving forward in today's video after this is the introduction of T account. That how the T accounts are made, which sides are very important in T account. Once you are good with the debit and credit concept, you need to know about this thing, that how the T accounts are made and how things have to be called. Okay, so this is a T account. Why do we call it a T? Because it's a long T. You can see this thing. It is the debit side of the T account. This is the credit side of the T account. Dollar signs are a must of this. You need to write the year of the transaction. Over here, you need to write the title of the account. on this. Okay. Again, maybe the account is capital. So how do we post the transactions? How do we do that? That's what I'm saying. Started business with 5,000 check. Okay, $5,000 by check. So what is this? Start of business means it is capital, and the next thing which is there in the question, because again there are two perspectives of that. Next thing is bank. Always try to identify two things in transaction. In the initial time period, it will be difficult for you, but with the passage of time, you will learn this thing that it is easier for you. So let's post the transaction. The title of the T account is capital. Sir, capital will be credited and cash will be debited. You know this thing very well. Okay? Because we have practiced it earlier. So bank should be debited. We know this thing very well. So sir, capital T account, you said this is the credit side and this is the debit side. The right hand side is the credit side. So sir, on let's suppose March 1st, I'm assuming it is March 1st, I'll write cash and I'll write the amount 5,000. In the capital T account, I'm making a credit entry as I've told you earlier. You can see this thing. But sir, why you are writing cash over here? You're not writing bank over here. You're not writing capital over here, just because in order to cross-refer the T account. We know this thing very well that an accountant who will be coming to see this T account will know this thing that why capital is being credited, just because cash is being debited. So we cross-refer the T account over there. Capital credit with the name of cash. Now if I make the cash T account over here, a smaller T account just for your understanding, so I'll write it over here. Cash. In the cash T account, I'll write capital with the amount 5,000. And again, the date should be the same. I hope you are getting this thing in the question, and the date should be same. So in the cash T account, if the accountant will come, we'll get to know that cash is being debited because of capital. So this means cross reference on the T account. So you don't write the same name in the T account. Like in cash, you cannot write cash inside the T account. You write capital or any other T account, any other offsetting T account, opposite T account, because of which it is being debited. So just remember this thing. Students tend to make mistakes. I'll suggest if you go to Frankwood book and solve some questions so that we could be done with the T accounts concept. I'm trying my level best to come up with a video of balancing of T accounts in the next class, and then we'll move forward to the trial balance. Okay. So if you liked the video, if you understood anything, if you did not understand anything, you can comment below. If you understood everything, share this video with your friends, like, share, comment and subscribe, and see you again in the next video. Thank you for watching.